Think about this for a moment. In 2005, Google was just a search engine. In 2008, Bitcoin was nothing. In 2010, most people laughed at electric cars. In 2012, no one believed people would make millions posting videos online. And yet each of those ideas turned into multi-billion, even trillion-dollar industries. History teaches us one powerful lesson. Massive wealth is created early, before the crowd arrives. Today's video is about identifying the next billion-dollar industries. Not hype, not get rich, quick schemes, but real sectors where capital, technology, and human behavior are converging. If you are an investor, entrepreneur, content creator, or simply someone who wants to stay ahead of economic change, this video matters because the future rewards those who prepare early. The 1990s belonged to the internet, of the 2000s to mobile and social media, of the 2010s to cloud computing, e-commerce, and digital platforms. The 2020s and 2030s will be different because they are driven by scarcity, automation, demographics, and survival-level innovation. When you zoom out and look at how wealth has historically been created in America, a clear pattern emerges. The biggest winners are rarely the ones reacting to change. They are the ones positioning themselves while change still feels uncomfortable, uncertain, or even unpopular. And this is especially important today because the speed of innovation is compressing timelines, meaning industries that once took 20 or 30 years to mature are now scaling in 5 to 10, which leaves far less room for late movers to catch up. And this is why understanding second and third order effects matters just as much as spotting trends themselves, because for every obvious winner like artificial intelligence, there are dozens of supporting industries quietly building value behind the scenes, such as data infrastructure companies, semiconductor supply chains, cloud optimization services, and AI governance platforms that help businesses comply with regulations. And the same pattern applies to health tech, where it's not only biotech firms that will win, but also logistics companies handling cold chain delivery for personalized medicine, insurance platforms integrating predictive health data, and cybersecurity firms protecting sensitive medical information. And when you examine clean energy through this lens, the real opportunity expands far beyond solar panels or electric vehicles into areas like grid resilience, energy forecasting software, recycling of batteries and rare earth metals, and even insurance products designed for climate-related risk, all of which represent massive pools of capital waiting to be organized more efficiently. And this is where many individual investors and entrepreneurs underestimate their advantage, because while they may not have the resources of large institutions, they have flexibility, speed, and the ability to specialize deeply in niches that big players initially overlook. And in a country like the United States, where capital markets reward innovation and risk-taking, niche expertise can quickly translate into disproportionate opportunity, especially when combined with digital distribution and personal branding, which ties directly into the creator economy and education technology as accelerators of all other industries, because knowledge itself is becoming a tradable, scalable asset, and those who can explain complex topics like AI, finance, energy, or health in clear, relatable ways are not just educators but economic nodes that attract trust, influence purchasing decisions, and shape public perception. And as traditional institutions struggle to keep pace with rapid change, individuals who build credibility online increasingly fill the gap, creating ecosystems of courses, communities, tools, and services that generate recurring revenue while also feeding talent and innovation back into these emerging industries. And this feedback loop is important because it means the next wave of billion-dollar companies may not start as companies at all, but as audiences, platforms, or open source projects that later formalize into scalable businesses. And from a macro perspective, the United States is uniquely positioned to benefit from this shift due to its entrepreneurial culture, deep venture capital markets, and ability to attract global talent. Yet this advantage is not guaranteed, because competition is global and other nations are aggressively investing in the same future-facing sectors, which means regulatory clarity, workforce education, and infrastructure investment will play a decisive role in determining which industries scale fastest domestically. And this uncertainty is exactly why diversification across themes, rather than betting on single companies, becomes increasingly important. Because while no one can perfectly predict which firm will dominate, it is far easier to identify the direction capital and innovation are moving, and align skills, investments, and businesses accordingly. And this alignment is where long-term wealth compounding truly begins, as small, consistent decisions made early can produce exponential outcomes over time, whether that means learning how AI tools can amplify productivity, understanding how digital finance reduces friction in global trade, or recognizing how demographic shifts drive demand for health and longevity solutions. And it's also worth acknowledging that every major economic transformation creates discomfort and resistance, often framed as fear of job loss, ethical concerns, or social disruption. Yet history shows that societies that proactively adapt tend to emerge stronger, with higher standards of living and more diverse economic opportunities. And the key difference between those who benefit and those who fall behind is not intelligence or luck, but willingness to learn continuously and abandon outdated assumptions, because the industries of the future reward adaptability more than credentials, curiosity more than certainty, and strategic thinking more than short-term speculation. And this mindset is particularly critical in an era where information is abundant but insight is rare, making it easy to confuse noise with signal. So the real skill becomes filtering trends through first principles, asking who benefits, what problem is being solved, how scalable the solution is, and whether it aligns with long-term structural forces rather than temporary cycles. And when you apply this framework consistently, the next billion-dollar industries stop feeling mysterious or intimidating and start appearing as logical outcomes of technological progress, human needs, and economic incentives converging, unfolding gradually and unevenly, creating windows of opportunity for those paying attention long before mainstream narratives catch up. And this ongoing process of observation, learning, and positioning is what separates passive spectators from active participants in the next phase of wealth creation. Another critical element that often gets overlooked in discussions about future industries is the psychological shift required to participate in them effectively, because new economic eras reward a different way of thinking than old ones, and many people remain trapped in mental models shaped by a world of linear careers, stable industries, and predictable progression, while the emerging economy is nonlinear, modular, and constantly evolving, meaning income increasingly comes from multiple sources rather than a single employer, and value is created by combining skills across domains instead of mastering one narrow function for decades, which is why those who develop an interdisciplinary mindset tend to outperform, as they can see connections between technology, finance, behavior, and policy that others miss. And this is particularly relevant in the United States, where cultural emphasis on specialization is slowly giving way to an appreciation for adaptability and lifelong learning. And as automation handles more routine tasks, human advantage shift toward creativity, judgment, and the ability to synthesize information across complex systems, making roles that sit at the intersection of industries especially valuable, such as professionals who understand both healthcare and data science, or finance and software, or energy systems and public policy, because these hybrid roles become essential bridges during periods of transition, and they often command premium compensation or lead to entrepreneurial opportunities that don't exist within siloed structures. And as these transitions accelerate, capital increasingly flows toward platforms rather than products, because platforms can adapt as markets change while static products struggle, which explains why investors favor ecosystems that enable others to build on top of them, whether in AI, fintech, education, or clean energy. And this platform dynamic also changes how competition works, shifting it from zero-sum battles to network effects where the largest ecosystems attract the most talent, data, and users, reinforcing their dominance. Yet even within these ecosystems, there is ample room for smaller players who provide specialized tools, services, or insights that the platform itself cannot efficiently deliver, and this is where many billion-dollar outcomes quietly originate, growing steadily by solving very specific problems extremely well, often for business customers rather than consumers, which tends to be less glamorous but far more profitable and defensible over time. And understanding this distinction can help individuals avoid chasing hype and instead focus on durable value creation, because while consumer-facing trends grab headlines, enterprise adoption often drives the deepest and most consistent revenue streams, especially in sectors like AI, cybersecurity, digital finance, and health infrastructure. And as enterprises modernize, they not only purchase technology, but also demand training, compliance support, integration services, and ongoing optimization, creating entire secondary markets that expand alongside the primary industry. And this layered growth is what makes certain sectors capable of generating multiple billion-dollar companies rather than just one dominant winner. And from a societal perspective, these changes also reshape how risk and stability are perceived, because traditional notions of job security are being replaced by skill security, where the ability to remain employable depends on continuous learning rather than tenure. And this shift places greater responsibility on individuals, but also grants greater autonomy, allowing people to align their work more closely with emerging opportunities rather than waiting for institutions to catch up. And for those willing to embrace this responsibility, the upside can be significant, as early movers often gain reputational capital that compounds just like financial capital, opening doors to partnerships, investments, and influence that are difficult to replicate later. And this reputational aspect is especially powerful in the digital age, where credibility can be built and distributed globally at low cost, enabling individuals to participate in billion-dollar industries without needing to own factories or massive physical infrastructure, and instead leverage knowledge, networks, and digital platforms as their primary assets, which fundamentally changes who gets to participate in wealth creation, expanding it beyond traditional gatekeepers. Yet this democratization does not eliminate competition. it intensifies it, making clarity of purpose and strategic focus more important than ever. Because with so many options available, those who try to chase every trend often end up mastering none, while those who choose a direction aligned with long-term structural forces and commit to it consistently tend to see compounding returns, and this consistency becomes a competitive advantage in itself, as most people underestimate how powerful steady progress can be over 5 or 10 years, especially in fast-growing industries where early effort benefits from expanding demand, and as demand grows, standards rise, favoring those who have already built experience and credibility, further widening the gap between early adopters and late entrants. And this dynamic explains why looking ahead and preparing now is not just an investment strategy, but a mindset shift, one that prioritizes foresight over comfort and long-term positioning over short-term certainty. And as the next decade unfolds, this mindset will increasingly determine who merely observes the rise of billion-dollar industries and who actively participates in shaping them. As these industries continue to evolve, another layer of opportunity emerges from the way regulation, ethics, and public trust interact with innovation, because in the United States especially, industries do not scale purely on technical merit, but on their ability to align with legal frameworks and social expectations, which means that some of the most valuable companies of the future will not necessarily be the most disruptive in appearance, but the most effective at navigating complexity, translating innovation into forms that regulators, institutions, and the public can accept. And this creates enormous demand for expertise in compliance, risk management, ethical AI, data privacy, and transparent governance, all of which historically were seen as cost centers but are rapidly becoming competitive advantages as businesses that can demonstrate trustworthiness gain faster adoption, stronger partnerships, and lower long-term risk. And this trust premium becomes especially important in sectors like digital finance, healthcare, and artificial intelligence, where misuse or failure can have systemic consequences, prompting governments and corporations alike to favor solutions that prioritize reliability over raw speed. And this shift subtly changes how value is created, rewarding companies and individuals who can operate at the intersection of innovation and responsibility. And as a result, careers and businesses that once seemed peripheral are moving to the center of economic relevance, including policy analysts who understand technology, lawyers who specialize in digital assets, ethicists embedded within product teams, and educators who help workforces adapt to rapid change. And this expansion of roles reinforces the idea that the next billion-dollar industries are ecosystems rather than isolated markets, where progress depends on coordination across multiple disciplines. And for individuals, recognizing this interconnectedness can unlock opportunities that are less crowded and more resilient to competition. Because while many people rush toward the most visible roles, fewer are willing to specialize in the supporting functions that every large industry ultimately depends on, and these supporting functions often scale quietly but powerfully, benefiting from long-term contracts, recurring revenue, and deep integration with clients, which in turn creates stability even in volatile economic environments. And volatility itself is another defining feature of the coming decade, as rapid technological change, geopolitical uncertainty, and shifting monetary conditions combine to create cycles of disruption and adjustment, making adaptability not just a growth strategy but a survival skill. And this environment favors those who can remain calm amid uncertainty, analyze second-order effects, and make decisions based on probabilities rather than predictions, understanding that no forecast is perfect, but preparation increases the odds of favorable outcomes. And this probabilistic mindset aligns closely with how successful investors, entrepreneurs, and strategists operate, continuously updating their assumptions as new information emerges, rather than clinging to fixed narratives. And this flexibility becomes increasingly valuable as innovation blurs traditional boundaries between industries, causing finance to overlap with technology, healthcare to intersect with data science, energy to merge with software, and education to integrate with media, creating hybrid markets that did not previously exist and therefore lack entrenched incumbents, making them fertile ground for new entrants who can move quickly and think creatively. And in this context, geographic concentration matters less than ever, because while major innovation hubs like Silicon Valley and New York still play important roles, digital connectivity allows talent from across the country to contribute meaningfully, enabling regional ecosystems to emerge around specialized strengths, whether in clean energy, manufacturing technology, health research, or digital media. And this decentralization of opportunity can broaden participation in wealth creation, while also intensifying competition for attention and capital, reinforcing the importance of differentiation, clarity of value proposition, and consistent execution. And as capital becomes more selective in an environment of higher interest rates and tighter funding conditions, projects and businesses that demonstrate real traction, clear demand, and disciplined growth are more likely to succeed than those driven purely by speculative narratives, signaling a maturation phase for many emerging industries where fundamentals matter more than hype. And this maturation does not slow opportunity, but refines it, separating sustainable models from fragile ones. And for individuals navigating this landscape, the most effective approach is often to think in terms of optionality. Building skills, networks, and assets that create multiple pathways forward rather than relying on a single outcome, because optionality increases resilience and allows one to pivot as industries evolve. And this approach mirrors how successful companies operate, investing in research, partnerships, and talent that give them flexibility to adapt, rather than betting everything on one untested assumption. And over time, this accumulation of options compounds into leverage, enabling faster movement when clear opportunities arise. And while this process requires patience and discipline, it aligns with the deeper truth of long-term wealth creation, which is rarely the result of a single dramatic decision, but rather the outcome of many small, well-considered actions taken consistently in the right direction, informed by an understanding of where the world is going rather than where it has been. And as the next wave of billion-dollar industries continues to take shape, those who internalize this way of thinking will be better positioned to recognize opportunity not as a moment to be seized impulsively, but as a trajectory to be joined thoughtfully and intentionally as it unfolds. When you bring all of this together, one truth becomes impossible to ignore: the future of wealth will not be built by chance, but by clarity, preparation, and the courage to think ahead while others remain focused on the present. Because the next billion-dollar industries are not distant ideas or abstract theories, they are already forming around us, shaped by technology, demographics, energy needs, and the transformation of how humans work, learn, and live. And the people who benefit most will not necessarily be the smartest or the richest today, but those who choose to understand these shifts early and align their skills, investments, and mindset with long-term forces rather than short-term noise, recognizing that real opportunity rarely announces itself loudly, but instead rewards those who pay attention, stay patient, and act deliberately. And in a world moving faster than ever, the greatest risk is not making the wrong move, but making no move at all. So whether you are investing your money, your time, or your attention, the decision to prepare for the future is the most valuable investment you can make, because history consistently favors those who position themselves before the crowd, build continuously, and refuse to let uncertainty become an excuse for inaction. And the question now is no longer whether these industries will reshape the economy, but whether you will be a passive observer of that transformation or an active participant in it, shaping your own financial future with intention, discipline, and foresight.